When investors invest, they're really investing in two things. One, to the extent that it's a single asset syndication, they're investing in the property. But secondly, they're investing in you. And so you want to be able to convey to them that you are a good steward of their money, that you're trustworthy, that you know what you're doing, and to the extent you come across a hurdle or a bump, that you will be the one to figure it out.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. Hello and welcome to episode 114. Since I started hosting this podcast, a lot of listeners have been asking me to talk more about syndication, which is essentially the pooling together of money from investors to take down larger deals. And I know that today's guest is going to be the perfect person to walk us through the process of syndication, the rules you need to follow, and the types of investors you can include. Amy Wan is the founder and CEO of bootstraplegal.com. She's also an attorney specializing in real estate syndication and crowdfunding for entrepreneurs and investors across the globe. Her mission is to democratize access to legal counsel and capital. Amy, welcome to the show.
Thank you so much for having me.
Before we get into syndication, and I know that we're both going to really focus on the basics and the steps of syndication for those who are out there who may have done it or may not have done it but are interested in syndicating. But before we get into that, why don't you tell us a little bit about yourself?
Sure. So I've been in real estate syndication and crowdfunding for actually quite a few years now. So I started my career in the federal government. And then when I moved from DC back to LA, I actually became general counsel of one of the larger and first real estate crowdfunding platforms at the time, Patch of Land. And what we did there was we basically syndicated or crowdfunded fix and flip debt. After that, I was a partner over at Trowbridge Sidoti, or crowdfunding lawyers, where pretty much all we did was focus on real estate syndication. And, most recently I left the firm to start Bootstrap Legal because I felt like there was a better way to do what I was doing as an attorney.
Yeah, and what you were doing as an attorney, was it basically helping investors and entrepreneurs raise money through syndication?
Exactly. So it's the legal aspect of that, right, which requires drafting a lot of paperwork. It's a lot of documents, and it takes a lot of time, which means it can be sometimes pretty expensive, pretty costly. And I thought, for the smaller investor, the transactional cost often doesn't make sense. And so I thought, man, if we could find a way to at least even partially automate this and bring down the cost, then we can actually open up syndication to more types of investors, right? Not just the large commercial, multifamily, public storage guys, but even the smaller people. So, getting down into the weeds of, smaller residential deals, those can be syndicated as well if you can afford the transactional costs of legal.
Why don't we start with the basics here? Tell our listeners, what is syndication and who would be interested in utilizing syndication?
Sure. So I think you pretty much described it perfectly when you started the show. It's basically group investment, right? Maybe I, as a real estate investor, don't have enough money to take down one property or take down a group of properties for the next couple months. So instead of me trying to put down all of my money, or me and my business partner trying to do that, we're going to go out, we're going to find some passive investors, we're going to pool their capital, and that's going to help us do our business. So that's what syndication is in a nutshell. In terms of who needs it, it's basically, I look at the Bigger Pocket forums sometimes, and I think the one true thing about Bigger Pockets is everyone's always looking for money, right? Whether it's in the form of debt or equity or whatever, everyone's lking for money. And we're always trying to raise it yesterday. So, It's really those types of people, the people who, they don't have enough to close on a property or make a down payment themselves. So they're going to go out and pool capital from their family, friends, or a network of investors.
And let's take it from there. Let's say that, let's say I find a deal and I need to raise $1 million to be able to take down an apartment building. But I've never syndicated before. Where do I start? What do I do?
That's okay. So the one thing I would say, this is maybe the pre-step to anyone who's even thinking about syndicating now or in the future, is it's a acronym, I say, right? ABN, always be networking, because it's kind of like one of those things when you're finding a job, right? By the time you actually need to find an investor, or by the time you need to find a job, it's kind of too late to start networking around. So what you want to always be doing is be social, go out to RIAs, go out and talk to potential investors, but always be networking and building up an Excel spreadsheet or an email list or something of people who are interested in investing in you and your deals. So that's kind of the overarching pre-step that everyone should be doing, whether they are, an experienced syndicator or a beginning syndicator. So number one. Number two is you have to decide what your strategy is, right? So let's say you have a $1 million property. Maybe you're only raising for that $1 million property. You can also do it for a group of properties, right? And this is what we sometimes call a blind pool or a semi-specified fund. So a blind pool means I generally have a business plan. Maybe my business plan is to take down, multifamily apartment buildings in the Texas region, right? Or the southwestern United States. If that's my business plan, I go to my investors and say, hey, I haven't found any properties yet, but I do plan to do so in the next 12 months. And this is how much I'm trying to raise from investors to be able to close on those properties. And the thing that's kind of in the middle is maybe you found one property, but you still want to take down a group of properties. That's what we call a semi-specified fund, right? You've specified some of it, maybe that $1 million apartment building, but then there's other ones that you haven't actually found yet. So there's a lot of different strategies you can employ. Usually for beginning syndicators, I see either people do blind pools, or they've actually specified one property and they're going to specifically take down that one property. We call that a single asset syndication. So
to recap, just make sure that I'm on the same page with you. There's three types of syndication that you typically see. You have the...
So there's single asset syndication, which is you're syndicating one specific property. There are semi-specified funds where you've identified at least one property, but there are other properties that you want to be able to invest in that you haven't yet identified. And the third one is a blind pool. You haven't identified any properties. You just have a general plan of what you plan to do with the money that you're raising.
Okay, so let's say, going back to your networking, always be networking. That's where it starts. This is where the money's going to come from, the people in your network. Are there certain things that I can say to those people while I'm networking with them? And are there certain things that I should not say to them?
Well, let's start with not saying, right? You certainly don't want to say anything that's untruthful, right? When you are networking, to the extent that you don't have, we call it an offering. An offering is, a specific thing that you're trying to raise for, right? To the extent that you don't have an active offering going on, I mean, the truth is, what are you really going to say? You're not going to make any promises or anything like that. You certainly don't want to lie, right? If you've never syndicated before, you don't want to tell them, hey, I'm an experienced syndicator. I have a track record of 40% IRRs, right? That's definitely not good. But what you want to do is come across as trustworthy, friendly, responsible, because at the end of the day, I always tell people, when investors invest, they're really investing in two things. One is, to the extent that it's a single asset syndication, they're investing in the property, right? But secondly, they're investing in you. And if you're doing a blind pool, they're pretty much only investing in you. And so you want to be able to convey to them that you are a good steward of their money, that you're trustworthy, that you know what you're doing, and to the extent you come across a hurdle or a bump, that you will be the one to figure it out.
And can I say that a return is guaranteed?
Absolutely not. When it comes to investing, as you and I both know, returns are never guaranteed. You may not even get your principal back. That's what it says all over the legal paperwork. And honestly, I think there's definitely a group of people who raise money who like to, pound on their chest and talk about how great they do. But I actually find that people don't talk about this so much. But I think that if you are upfront and trustworthy, and you talk about all the potential downsides of syndication or whatever you're doing, I think it actually makes people trust you more sometimes, right? Because you're telling them, hey, I think I'm going to be a good steward of your money, but I do want you to know everything going in. I want you to know that, if there's another huge downturn or whatever, that you might lose all of your money. But, I still want you to place your trust in me. And I honestly do think that if you tell people the downsides, that they're actually going to trust you more than the guy who beats his chest.
Yeah, and I would agree with that, because I've syndicated 3 times. And, I always say, look, I don't guarantee anything. I can make projections, but whatever money you invest, you have to be willing to lose it if the worst case scenario happens. Or at least be able to lose it without being devastated. And, one way or another, if you're syndicating properly, you're going to have to disclose what all the downsides are anyway. So you might as well make sure they're aware of it up front.
Yeah, definitely.
So let's talk about the type of investors you're as you're networking. What are the types of investors you should be looking for? Because not everybody is able or right for investing in syndications.
Right. So, all of this comes down to SEC rules and regulations, right? The SEC is the U.S. Securities and Exchange Commission, and what they do is they regulate basically the capital markets. So their goal is to promote capital formation, right? They want to promote the ability of people to go fundraise money, but at the same time, they have this competing interest of they need to be able to protect American investors. And so that basically boils down to a couple things. You basically have accredited investors and you have non-accredited investors. Now, what this means, it's kind of an arbitrary threshold, to be honest. But an accredited investor is basically a rich person, right? Now, exactly what that means is they have had over $200,000 in annual income over the past 2 calendar years, or $300,000 if they file jointly, or they have over $1 million in net worth, excluding their primary residence, so the house that they live in. So that's what the SEC defines as an accredited investor. The reason why they put forward that definition is their mentality is, hey, if someone has a lot of money, it's not a huge deal if they lose a lot. And presumably, if they have a lot of money, then they're probably a little bit more sophisticated with their money. What they don't want is they don't want people going out and raising money and promising crazy things to grandma and getting her last Social Security check or whatever it is, and then grandma's, homeless and out on the streets. So when it comes to raising money from accredited investors, things are generally okay. When you're trying to raise money from non-accredited investors, you have to be more careful. And who you can raise money from depends on what rule you are using when you're raising money. And there's a couple different rules.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. Could you just tell us what those rules are?
Yeah, so I'll just give you the quick and simple version, right? So the traditional rule that pretty much everyone has been using for the last several decades is something called Rule 506B, as in boy. So what that basically says is, hey, you can raise as much as you want. However, you cannot advertise, right? You really have to be reaching out to people you already know. We call this someone's pre-existing network. And in terms of who you can raise from, you can take money from as many accredited investors as you want, but you are limited to no more than 35 non-accredited investors, and those non-accredited investors need to be sophisticated. They need to understand what they're investing in. So, generally what I tell everyone is just remember that the more freedom the SEC gives you in going to raise money from who, how you advertise, right, the more they're going to ask in return. The second one, and this is, there are 3 crowdfunding rules. This is what we call the accredited crowdfunding rule. It came out from under the Jobs Act. It's Rule 506C as in cat, right? And so what that says is, hey, you can still raise as much as you want. However, this time, we're going to let you advertise, right? You can tweet things out. You can post on LinkedIn. You can post on BiggerPockets. You can grab a mic and yell to the crowd about your offering. However, the only people who can actually invest or give you money are accredited investors, and you have to actually verify that they are accredited. You don't have to do that under 506B. The third one is regulation crowdfunding, and we call it Reg CF for short. And what that basically says is, okay, you can raise up to $1 million in change. You can raise from non-accredited investors or the crowd, and we're going to let you advertise. However, in order to use this regulation, your offering does have to be listed on a FINRA-registered funding portal or broker-dealer. So, it's more regulated that way. You still do have to file some paperwork before you go raise that money. And then lastly, what I want people to keep in mind is, with every rule or regulation you use, there is some sort of strategy involved, right? And when it comes to regulation crowdfunding, I say that at least for real estate people, it's really only for beginners because, experienced syndicators, for example, they're going, $1 million per year just really isn't going to cut it for them. And the last one is for really experienced syndicators. So this is called Regulation A+. You can raise up to $50 million every year. You can raise it from the crowd, so non-accredited investors, and you can advertise, but this requires, it requires a slightly more complex process. You have to go and get what we call qualification with the SEC beforehand, right? So the SEC does have to actually approve this beforehand, as opposed to any of the other regulations I've talked about. And that's usually a 4 to 6 month process. So if you're doing a single asset syndication, that's probably not going to work, right? Because, you probably want to close before 4 to 6 months. But if you are, for example, doing a blind pool or a fund, that's usually a better strategy for Regulation A+, because, then you can take down a lot of properties and, you don't have an immediate closing deadline or escrow that that you've got to raise money for.
So those are a lot of choices and a lot of rules. Let's take it back to the level of just when you're talking to your network, and the type of, obviously you want to associate with more accredited investors, but how do you prove, is there a way that you have to prove that, hey, this person actually is part of your network? Because I know that's one of the things the SEC looks at is how long you've had a relationship with someone.
Yeah, sure. So there isn't necessarily any, specific method or outline that the SEC has said that you have to have in order to prove that you already know someone, right? However, what I usually tell my clients is there are best practices. So for example, I have some clients who, when they get an inbound call from a new potential investor, right, or they meet a new potential investor over the internet, they will keep a log of it, right? They will put down in a notebook or an Excel spreadsheet or something the first 3 interactions that they've had with that investor, just so that if they ever get audited by the SEC, that they can prove that, it wasn't just, they met this person while they were trying to raise, because generally that's not what you're supposed to do under 506B. Now, in terms of proving accreditation, that's another story. It depends on what rule you're raising under. So the 2 rules that matter are 506B and C, right? 506B, if you remember, we can take as many accredited investors as we want, but we can still take a couple of non-accredited. In that case, because you're not advertising to the world, the SEC is a little bit more lenient. So they just say, hey, you can, you just need to have knowledge of this investor. So understand their financial suitability. Maybe they can take a survey, a questionnaire. A lot of times what we do is when attorneys give legal documentation to clients, they'll give a subscription agreement that has a lot of questions for the investor to fill out. And those questions all ask about, hey, what's your investing experience, et cetera, et cetera. And it allows them to self-certify that they're accredited. Now, when it comes to 506C, because you've been advertising, it's so easy for people to lie, especially on the internet these days. And so the SEC is a bit more strict with that. So they say that you actually have to verify that, or take reasonable steps to verify that someone is accredited. And what that means is that the investor does actually have to give you, for example, pay stubs, W-2s, a credit report, and somehow prove their annual salary for the past 2 years or their net worth, right? So it might be brokerage accounts, 401ks, things of that sort. Some syndicators do verify all that themselves. Others prefer to outsource it to a third party. So there's a lot of third parties out there that are verification services that will go through all this paperwork for you, and some of them also have databases, right? So to the extent that that investor has come through before, maybe the verification process is super easy because they invested in someone else's deal 6 weeks ago, so they already have the paperwork and they can instantly give you a verification.
So just to compare the 506B to the 506C, with 506B, you're working with your network. You're not able to advertise, but you're also able to let your investors self-verify that they're accredited. Whereas with a 506C, there's a lot more incumbent upon you as the person syndicating to verify that your investors are indeed accredited. But the upside there is that you get to advertise and you don't have to have that pre-existing relationship. Is that how it works?
Exactly. And so I think I mentioned, that there's an art to, which regulatory strategy that you're using when you're raising money. So for example, a lot of my experienced syndicators, right, usually they'll do 506Bs, but sometimes they'll mix in a 506C once every couple of deals. And so the reason they do that, for example, is because they already have a large list of investors, but everyone's always trying to grow that list of investors, right? Because what happens if one day you exhaust that list as a capital source? So what they do is they will occasionally throw in a 506c to be able to advertise about the offering and about themselves, right? They'll get a new crowd or a new, what do you call it?
New group of investors?
Yes, exactly. And so they bring them in through that offering. And once you season those investors for a while and you get to know them, after a certain period of time, you can actually, email them about your next 506b deal.
What is that period of time?
Generally, we recommend 6 months.
So from the point when you meet an investor, and this seems like it would apply to 506b, from the point when you meet a potential investor to when you actually show them a deal, you need 5 or 6 months in between?
No. So if you meet someone through a 506c deal, and then you want to get them into a 506b deal, we recommend to be safe 6 months, although you should always talk to your attorney about that. If you are just meeting someone for the first time and maybe you want to get them into your 506b deal, there's actually the SEC has said there's actually no time period under which you have to necessarily season them. You just can't really show them an active deal that you're raising for, at that exact point in time when you meet them.
Can you have a deal on the table when you first meet this investor, not tell them about it, but then show it to them a month later?
Ooh, that's a good question.
Because I remember, actually, I learned about syndication from Gene Trowbridge. He did a seminar through another network, and I seem to remember him saying that if you have a deal that you're trying to raise money for and you meet a potential investor, you cannot show them that deal. Maybe I misheard, or maybe that's not the case anymore.
So generally, it's not advisable, but what I usually say is that law is not black and white. It's a lot of gray, right? Mm-hmm. And so, I know there are people who are doing this and they cross the gray into, the black a bit. But when it comes to being safe, right, I think everything comes down to risk, right? Are you like some young person, you don't have that much, you don't really have anything to lose, and you're not scared of the regulators? That those people are going to do whatever they want. The people who, they have something to lose, they've got kids, they've got a family, they don't want to go to jail, they don't want to get in trouble with regulators, and, they're serial entrepreneurs. They are regularly in the business of raising capital. They try to usually do things the right way because once you get a black mark from the SEC, that basically affects your credibility going forward. People, A, aren't going to trust you as much, but B, you may not even be able to raise capital anymore. This is what we call someone who has been labeled a bad actor by, state or federal regulators. Usually when people ask me about the consequences of, what happens when I break the rules, you have to kind of do something a little bit more egregious to break the rules. But at the same time, fines don't usually scare people. Criminal charges, it scares people a little bit. What really scares people, I think, is, one of these deals where if you get labeled as a bad actor and you're not able to ever raise money or participate in any other companies being able to raise money again, like you're done. Like that's it for you as an entrepreneur, So generally, I tell people try to stay in the safe side. Try to stay in the gray to the white.
Since we're talking about the gray area and potential ways you can get in trouble with the SEC, where have you seen actual instances where the SEC has come down on syndicators?
Oh man, there's so many. I mean, the worst things you can do is lie, make some sort of material misstatement or some sort of omission, right? So you got to tell your attorney everything. If you have ever been labeled a bad actor, if you've ever been sued or prosecuted for fraud or anything like that, you have to tell your attorney. Even if you have had a recent bankruptcy, you still want to disclose that. It's always better to do so than not. I've seen it in situations where, people promise that they're going to do one thing with the money, and instead they go off and they buy castles in Switzerland and drive Ferraris, and you would actually be surprised by the number of people who try to do this. There are people who, the regulators will go after them for, not being fully compliant or not quite doing things the right way. So, for example, I remember one of the first enforcement actions against a crowdfunding offering was there was a website in Dubai, and they were listing deals, and they said that they weren't taking U.S. investors so that they wouldn't have to comply with U.S. law. But in fact, they actually did take 3 U.S. investors. They did not verify their accredited status. And so the SEC, did an enforcement action against them. I mean, if you subscribe to the SEC website, they will go out and, do a press release or enforcement action pretty often. So don't be one of those people.
Yeah. So there's a fine line between the people who are deliberately doing it wrong and engaging in criminal behavior, like buying a castle in Switzerland with their syndication money, and then the earnest investor who is actually raising money for a particular type of deal. Where is it that you've seen like that earnest investor get in trouble through making either a simple mistake or some sort of tragic error?
So the earnest investor usually doesn't get in trouble with the SEC, but who they get in trouble with is their investor, right? So this usually happens in 2 situations. One is when they've lost the investor's money somehow. Or B, if they're taking money from friends and family, people always think, oh, I'm taking money from friends and family. It's okay. They'll never sue me. And then when someone gets divorced or someone gets in an argument and all rationality flies out the door, then people do interesting things to each other. But when those types of situations happen, it's actually not the regulator that you're usually in trouble with. It's the plaintiff's bar, right? So they'll go hire an attorney to go sue your pants off. And in that case, it's very helpful to have legal documentation that says, hey, by the way, investor, if you're suing me, actually, you're the one who's footing the bill because that's what these documents say. And so, maybe you want to think twice before you sue me because then your returns will be even less.
So a handshake deal doesn't cut it. You got to have the documents to back you up.
That's what I would advise.
So you bring up another good point, and this is something I've heard people ask, which is, well, I've got 4 investors I'm doing this deal with, which is technically a syndication, right? I mean, a syndication is technically any deal with 2 or more investors. Hypothetically, if someone has a deal and they've got 4 investors, but they don't want to go through the trouble and the expense of syndicating, and they do it anyway, where can they get in trouble by doing that?
Well, basically they can either end up in litigation or maybe they get in trouble with, a federal or state regulator. That's basically what it comes down to. I know that, it's like, oh, I've got 4 friends, we're all friends, everything will be okay. But man, if you've seen the things that I've seen, not everything will be okay.
Yeah, and I think a lot of people proceed with that, like friends, family, it's all going to be good, but then something happens and it's not so good.
Yes.
That's where you see people getting caught up and getting in trouble, huh?
Yeah, what I usually say to people is, look, there's a reason I don't practice family law, right? Family law is when people get divorced and they're fighting over custody of children and all of that kind of stuff. I don't like doing family law because when you have those disputes, it's not, it becomes very emotional, right? And not so much numbers or business or whatever oriented. When you take money from friends and family, if you trust them, great. But, I can tell you a story that one of my attorney friends in San Francisco told me, last year, where she had a client. It was a husband and wife flipping team, and lo and behold, the husband dies. The husband's business partner goes and rallies all the investors to sue the wife, and we all think it was because the husband was secretly having an affair with the business partner. Like, you never know what'll happen.
Yeah. Good point. Okay, so I want to get into regulation crowdfunding, but before we go there, I want to make sure we've kind of talked through all the basics of the 506B and the 506C. Is there anything else we need to know about those two?
Only that, those are what people primarily use in real estate syndication and crowdfunding because they are the fastest and they can be amongst the cheapest methods.
And what would someone doing a 506B or 506C, what could they expect to have to pay to go through the syndication process?
Sure. So generally, if you are working with an attorney that is specifically licensed for real estate syndication malpractice insurance, they're going to charge you based on however much you're raising, because they actually have to report to their insurance provider every deal that they represent, and their premium goes up accordingly, right? So a $50 million raise is going to cost you more than a $1 million raise. But generally, I would say for $1 million raise, it starts at about $10,000, and it can go up from there to maybe like 25, 30, depending on what kind of law firm you're using. At least with Bootstrap Legal, we are marginally cheaper because there are parts of our process that are automated. And so for a $1 million deal, we actually start at $7,500 flat.
Okay. Yeah, and maybe this is a good place to talk a little bit about Bootstrap Legal before we go on to the regulation crowdfunding. How does Bootstrap Legal basically use technology and automation to kind of streamline the syndication process?
Sure. So I would compare our system to something a little bit more like TurboTax, right? So it's not simple document automation where it's just filling in the name, the address. It really is doing a lot more than that. We have over 800 code variables in our documents today. And basically, as an attorney, it's universally true that your client always calls you at 4 p.m. on a Friday and says, I need my documents as soon as possible. And so, in order to turn these drafts around faster, to make fewer mistakes, and to spend less time on each one of these deals, what we do is we actually automate a large portion of the drafting of the first draft. And really, as an attorney, I would probably take a template, the last template that was a close or similar deal, and I would work off of that. With our software, it's basically modularly built so that, even if I am working off of a draft that is close, but maybe it was with one property instead of two, right? Then I'm not sitting there pluralizing or unpluralizing 70 pages of each property versus the property versus properties, right? Which, is not, I think, extremely valuable work that you should be paying your attorney for. I think if a machine can do it, a machine should. So it's small things like that, right? Pluralization, making sure that you have the right language in the right places. And I actually think it prevents a lot of attorney mistakes. So basically what I'm saying is the software turns out churns out a first draft, and then the attorney takes it from there and gets it to the final draft. But in the process, like right now, I think we're probably saving 10 to 15 hours of time.
Wow. Can you walk us through the different documents that are needed in a syndication?
Right. So Bootstrap Legal specifically does it for Regulation D deals. So that's 56B and 56C. We do not do Regulation Crowdfunding or Regulation A+ deals. But at least for a Regulation a Reg D, 56B or 56C deal, you definitely need a private placement memorandum, and that's your main document. It's usually about at least 60 to 100 pages long. You will need operating agreements for however many entities you have, or it might be bylaws to the extent you have a corporation. You will need a subscription agreement, and that's the thing that I talked about earlier. It's something for the investor to sign, but it also asks them a lot of questions about themselves. And then there may be a couple other documents after that, depending on your specific deal. So, for example, if you are bringing on a foreign investor, there might be a foreign investor supplement or something of that sort. It kind of depends by deal.
Can you talk about the private placement memorandum, the PPM, and how important that is to the syndication process, and what's typically included in that?
The PPM is basically a massive document that your attorney spends a lot of time putting together. And what it does is it discloses to the investor everything that they should know about the deal, right? So everything from how much you're raising, when you're raising, who you're raising from, what regulation you're using, all the risks of the investment, right? All the things that they should know about you, what the anticipated distributions are going to be. For example, if you've got waterfalls or whatever. So it tells them the structure or the guts of the deal. And really it's kind of like the deal Bible, if you will.
And yeah, I always think like with the PPM, the private placement memorandum, you've got all these disclaimers that you put in there for the investors, and it's kind of like the pharmaceutical commercials where it's 10 seconds of commercial and then 50 seconds of disclaimers. It'll cause vomiting and itching and rashes and everything. I mean, that's really if you're when you read through those disclaimers in the PPM. You really have to prepare your investors for what they're going to read, because it could scare them off.
Yeah, I mean, the PPM usually has all the information the investor should know, right? And so it's one of those things where it is very intimidating to read, but at the same time, after you read a couple, you kind of know where exactly you should look and what you should be looking for, right? And, you'd be surprised. Like, I've certainly read things on other people's deals before where I'm like, oh man, like they totally hid this in here. If this were on the front page of the investment deal, I would not invest, Oh,
like what? Give me an example of what you've seen.
Oh gosh. One of my, favorite, and I say favorite sarcastically, but one of my favorite regulation crowdfunding deals was a deal where a guy was raising money, $1 million, for an electric car company. So I don't know what you're going to do with $1 million for an electric car company. Pay for the electricity? It was a brand new company. He was the only employee. He had never actually built a car, let alone an electric car before. And the company was 1 month old, and he was valuing it at $30 million. And I laughed. I think I almost fell out of my chair.
Wow. Someone how do you even get someone to invest? If you're crazy enough to invest in something like that, then maybe you deserve to lose your money.
It's, people were looking at the marketing, at the pretty pictures, but they didn't sit down and read the fine print. So
it was buried in the fine print that he really had no chance at all of having a successful company.
I was just like, man, how do you build electric cars with one person who's never ever built a car? I don't know.
Wow. Yeah, and it's important to realize that everything we're talking about here is you use it for real estate, but also entrepreneurs use it for businesses and raising money for companies as well.
Yeah, definitely.
Have you been able then to automate the PPM process, the operating agreement process, and the subscription package process?
Oh, yeah. So we do have a fully functioning prototype today that we've taken several deals through. What I tell people is, as an attorney, it's, being marginally cheaper, that's great, right? But I think what the real sell of our product is not the fact that it's a little bit cheaper, but it's the time you save. So as an attorney, when I went through the traditional process of here, let me give you an engagement letter and, oh, here's our wiring instructions, please go wire it to a bank, go stand in line at a bank. And oh, then I have to confirm your wire. And then we have to do an intake. And then I have to sit down, all of that just to get you to your first draft might take you 2, maybe 4 weeks, depending on the attorney you use. We basically tell people that, we're integrated with Stripe. Everything is e-signed. So, you can earn points on your credit card and you can pay instantly. We give them an adaptive questionnaire to fill out. We then hop on the phone with them to answer any of those questions. And then once they press the submit button, we tell them that we'll turn around a draft in 48 hours.
It sounds like you have actual legal people they can talk to on the phone for the legal part of it as well.
Yes. So, it is software, but it does, depending on, what plan you choose, it does come bundled with attorney services.
Mm-hmm. Now, do the services include getting the packages to the accredited investors or the sophisticated investors for them to fill out as well?
So I think everyone tends to have a different process around that, right? Some people still prefer, there are some investors who they still want to see papers, right? There are some investors who you send the legal documents to them by email. Some people now are uploading these onto DocuSign or some sort of e-sign platform. So we don't actually do that. We just give the documents to the syndicator and then they do with it what they will, because everyone kind of has a different process.
Well, let's talk a little bit about regulation crowdfunding, because now we're talking about something that's relatively new to the syndicating world. Can you tell us about that?
Sure. So regulation crowdfunding, as I mentioned earlier, it's one of those regulations that came out from under the Jobs Act. It's one of 3 crowdfunding laws, right? So the 3, just to review, are 56C, Regulation Crowdfunding, and Regulation A+. They basically all allow you to crowdfund, but in different ways with different people. So Regulation Crowdfunding is the one where you can raise up to $1 million and change every 12 months from non-accredited investors, but you must be doing it through a FINRA registered funding portal or broker-dealer.
And what is that? What is a registered portal or dealer? What exactly would that be?
Basically, it means that they are licensed and registered with a regulatory entity that is going to audit them pretty often and basically oversee everything that they do. They make those who are doing regulation crowdfunding offerings work with these providers because then they have a lot more oversight. And then because the providers of the platforms or the funding portals, whatever you want to call them, they in turn, know that they need to keep within a certain, set of rules. And so they're very careful about who they let on the platform.
So let me tell you my bias against crowdfunding, and
okay.
You can tell me, because I know you used to be part of a patch of land. You can tell me where I'm wrong, because it may be an uninformed bias. But my bias against crowdfunding is you're dealing with a lot more investors coming in with smaller amounts of money, a lot of investors who you don't know, and then you're also sharing the costs that you're paying to the portal or the crowdfunding service. Is taking money out of your pocket or the investment's pocket. That's kind of my biased opinion about it, but I'd appreciate your insight.
Sure, and you're absolutely right, right? And I'm talking about crowdfunding generally, not just regulation crowdfunding. You usually are taking smaller dollar amounts. Now, remember, first of all, it depends on what your strategy is, right? What if you are one of those experienced syndicators, but maybe your network of family and friends or your network of investors, you've exhausted all the capital there. If you can leverage the crowd, maybe it's your crowd, maybe it's all these real estate people that you've taught over the past 10 years, that's one avenue that some people are taking. Some people philosophically have an attitude that, hey, it's not fair that the rich are just getting richer. I want to give the non-rich people a chance. There is some talk today that, this is not a scientific study, but there is some talk today that generally at least for the real estate related deals that you see that are crowdfunding, the returns to investors, potentially these crowd investors and non-crowd investors, tend to be less than what they would otherwise give a crowd investors. So that's another consideration. And then there's the whole these are a lot of new beginners, adverse selection type concerns. But really, I think the people that you see who are using it most effectively, at least in the real estate world, they're not really using regulation crowdfunding right now, yet at least. I haven't seen it really take off. Most of them are either adopting 506C to go get new investors who are accredited, or they're employing a Regulation A+ strategy. So maybe they have this huge list of investors who, like I said, maybe they're students, maybe they're fans of their work, right? And now they're able to leverage them in large $50 million funds.
I'm glad you brought that up. You're not seeing the regulation crowdfunding being used all that much, but yet people were very excited about it several years ago. Why is it that regulation crowdfunding has not really taken off, and what do you see as the future for it?
At least for real estate, $1 million is not a lot that you can do with real estate in 1 year. So specifically for real estate, I think that's why, right? The second reason, and this is not related to real estate, but for everything, is just that the rules are very strict to raise just $1 million. A lot of experts, a lot of policy people think that the rules are still too strict, right? You're seeing that a lot of people using regulation crowdfunding are spending, maybe upwards of $20,000. And that doesn't even include marketing costs just to raise $1 million. It really is a lot of money, right? And so I don't think we've quite gotten there yet in terms of fine-tuning that balance between, strict regulations and rules to protect investors, but also promoting capital formation.
When you talk about the democratization of raising money and making these types of investments available to people, that was kind of the whole point of crowdfunding. But yet it seems like we've got a little ways to go. Do you think that we'll get there?
I don't know. If I had a magic crystal ball that could predict what Congress would do, I would certainly use it. But, in the interesting political climate that we have been in these past couple years, it's really hard to know where, Congress stands.
Okay, good answer. The answer is we'll see. Yeah, who knows? Who knows what they're gonna accomplish or not accomplish? Anything else then about crowdfunding or the other ways of syndicating that we haven't touched on?
At the end of the day, all this comes down to is regulatory strategy, understanding who your investors are, and understanding your own goals, right? So if you can nail down those three answers, I think whoever your attorney is, they'll have a lot easier time advising you on what strategy you should use.
People who are interested in bootstraplegal.com or finding out more about you, how would you like them to get a hold of you or utilize your services?
Sure. So they can just go to bootstraplegal.com, and there's a button that you can click to request a consultation. Otherwise, if people just want to follow us, we are on social media. So we're on Facebook, Twitter, LinkedIn, and they can just see what postings we're making over there.
All right. Well, great job just giving us the A to Z about syndication and keeping it at a level that I think a lot of our investors and listeners will really appreciate. Thank you so much for taking the time to talk about syndication with us today.
Of course. Thank you.
This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.